Hi, I'm Pattu from freefincal. If you are looking for a safe debt mutual fund for holding money for a year and more than a year, for at least a year and beyond, then you can consider funds in the money market debt fund category. So, a money market is a segment of the bond market where the commodity being traded is actually money. So, where you have instruments like call money or notice money or something, or certificates of deposits, and there are many other instruments. Essentially, a bank or an institution or an AMC can lend money for a few days, for a few months, few weeks, up to 1 year, and they can call it back. They can ask it back at any time, and for the time they're given it, they will get some interest. So that's called the money market segment. Um, if you look at the debt fund category scale in terms of increasing bond duration, the lowest is the overnight fund, where the bonds are essentially a day old, right? Typically 1 day, and every day the mutual funds portfolio will change. And next is the liquid fund, which can hold bonds up to 30 days. Sorry, up to uh, 90 days, that is 3 months, sorry, 91 days, I think. So that's the liquid fund category. The next is the ultra short term bond, which can hold between bonds between 3 months to 6 months, of course, also lower, but up to 6 months. And then you have something called the low duration category, between 6 months to 12 months. Uh, and then you have the money market, which is up to 1 year. So that's how the hierarchy goes. Then you have other higher duration funds. The reason I want to point out the money market category is that um, we have ultra short term bond. We have seen credit default events. Um, Still, I think there are funds which have credit risk, which are taking credit risk. Low duration, currently there are funds which are taking credit risk. Money market, at least currently, there are the portfolio seems to be fairly safe, at least currently. I'm not saying that will be the case in future also. So you can look at funds which have a high AUM, more than 5,000, 8,000 crores, something like that. The highest AUM would be better, so that the exposure to each bond is lower. And please study the scheme document, please study the portfolio history, and if you're comfortable with the kind of bonds that they buy, the kind of risks that they take, and the kind of returns they'll generate, anywhere between 6-7% roughly, little bit more than liquid funds is what you can get in this. Then you can consider funds in this category, but please beware that you should only choose a fund. Don't look at the category, because if you the category can why there are two things you need to know. One is the category, like any other mutual fund category, the variation will be very very huge. If you go to the portfolio and look at the average credit quality, as of now, I think the average credit quality is only AAA everywhere, which means the highest. And but if you look at the average maturity, the lowest is 0.02 years and the highest is about 0.54 years. So that's a huge difference in the. So some funds are basically holding almost cash, and some funds are holding bonds of a few months. So you have to be very careful about this. The longer the average maturity, the more will be the interest rate risk, and if there is a credit issue, there could be, the longer it will take to recover, and so on. So you have to be careful with this. You have to still do your due diligence, but you can choose this as a short list among all other funds. That is, see, you can broadly classify debt funds into two in terms of the interest rate risk. That is, funds which don't like to trade the bonds. That is, they will buy the bonds, they will hold until maturity, and they will then buy new fresh set of bonds. That they are called accrual type debt funds. The others, which like to trade the bonds based on interest rate movements and yield movements and try to get capital gains, These funds are basically the accrual type, those who hold until maturity. The gains they get primarily will be only the interest component, assuming there are no defaults and so on. But for the bonds, for the who that like to trade midterm, they are looking for capital gains, maybe even losses. When they trade and so on. So that's a very broad way to categorize funds. These are buy and hold kind of funds. Money market typically in this segment typically will be buy and hold. Not all of them need to do that. You have to look at a fund that says explicitly they try to buy and hold, and they say that they will focus on highest rated securities. They want to protect the capital. That's their focus. You have to look at the scheme wordings and then choose. Please be aware that this category is not above credit defaults. We just had a credit default in this category. L&T Money Market Fund had a credit issue because of the Diwan Housing Finance. Look at the star rating today, it's 5-star. How is that possible? Because star ratings have a short memory and they are bloody moronic. Well, no, the star ratings cannot be moronic, only the people who use them. So, look at that. Look at the NAV movement. That's the fall, and then there is a partial recovery, and then there's some more recovery. Of course, in this case, DHFL paid back the thing. That's why they recovered. Finally, there's a big jump. If you look at the star rating, this looks like a huge jump up in the NAV, right? So that's the reason why it's giving you that 5-star returns. Don't go by all that. Look at the past 1 year, 2 year, 3 year. Look at the past. See if they have taken any risk. Look at the portfolio. Look at the scheme document. You have to do some research. Otherwise, you can't invest in debt funds. Uh, if you are choosing in this segment fund with a large AUM, which clearly says they want to buy and hold, and they want to focus on buying the highest rated securities, and they want to protect the principal. If these are words that you want to look at either in the scheme document or in the presentation, then you can take a chance with that fund. I'm not saying that would be safe or that would be a great strategy, but that's something that you need to focus on. Even it is in this category that you have this Franklin Savings Fund. Remember that I told you I had made a video on this before. I think Franklin Savings is a very different kind of fund in the Franklin bond universe, other than the ones that focus on gilts. It doesn't take on much of credit risk, and this is an exception that's found in this category. So that's a category that I think you should explore. People who are looking for debt funds. Of course, you can say, why can't I just invest in fixed deposits? Yes, you can, but please invest in safe fixed deposits like the big three: SBI, ICICI, HDFC. These are the big three. Maybe Axis Bank to a certain extent. Focus on the big banks, safe banks. Use fixed deposits instead of debt funds. Okay, that's fine. But don't say I will go to fixed deposits and buy small finance banks. That's terrible. Compared to concentrated risk in a high yielding fixed deposit, a debt fund is any day safer if you know how to choose. It's not rocket science. People should not look at returns. That's the problem. These mutual fund investors, they can't think beyond returns. If you cannot do that, then you're going to suffer sooner or later. If you look carefully, do your due diligence, then you can invest safely in mutual funds. Some people have been asking, are you going to change your stance on Franklin debt funds? No, I'm not going to change my stand. I'm still going to recommend Franklin Ultra Short Term Bond Fund. I have been saying all the time, it's fire. If you touch and play around with it and get burnt, and don't blame me. I already told you it's fire. You didn't look carefully. So I'm not going to change my stance because of any credit defaults. Because I try to do due diligence. That's what everybody should do. So please explore this category. Explore research and then put your money in. I'm not making any fund recommendations in this category. I'm certainly not recommending L&T Money Market Fund. They have no business. Money market is supposed to be a very safe category, and they have no business taking on high credit risk. They just got away with it, and these bloody portals are rewarding them with 5 stars. So you got to do your homework. Then you can invest safely in debt funds. I mean, not safely, at least with a relative peace of mind, or well, as safe as you can possibly get in this. Bye bye.